All right, when I'm ready to go to screen, I'll just tell you that, right? All right, folks, welcome to the paradigm shift.
Yeah, we don't have any of that in
You can hear me?
Yeah, we can hear you.
Okay. All right, so again,
Tell them, hold on 1 second.
hold on 1 second. We'll start in about 60 seconds, I believe.
Then you can go to your home screen.
So what I'm going to be showing?
Yeah, then you can go to your home screen so you can help us.
All right,
Because I got to pull up switch.
there you go right there.
Let me go to the,
Yep.
yeah. Hit, accept and both.
Both of them ready? It says ready.
Yep, say ready.
Hit them.
Yep, hold on 1 second. Yep, hit him.
How does it work?
Ready, accept.
Okay, now I have to do it here. All right, folks, hold on a second. We getting this, trying to get our switcher working here.
Okay. 1 second.
All right, so while we're waiting for the continuation, okay, running, boom, we're good. Okay, so let's start this over again. Let's see. Hold on. All right, I remember where that was at. Okay. Good afternoon, good evening. Welcome to the Paradigm Shift podcast. And today we're going to be talking about technical analysis of financial markets. We're presenting from the Academy in Buffalo, New York. And this is going to be our last version of technical analysis of financial market for our first season. So this is May right now, and we started our first season in February. As you can see, we're learning by doing, but our product and our services are increasing significantly. So we'll be coming back in the fall semester in September. But again, this is our last session of technical analysis of financial markets. So what I'll be doing is I'll just let you know a little bit about we'll review some of the material that we covered over this spring semester. The idea of financial literacy in the Black community, the financial habits of the poor, the middle income class, and the rich, and recognizing that part of the solution to our financial liberation, as one of my business partners will talk about, to our financial liberation is really understanding finance. And part of understanding finance is the understanding of buying and selling of assets in the financial markets. But even before that, right? Again, this is, the whole framework is built around political economy, Black political economy in particular. So even before I go into a discussion of technical analysis of financial markets, just want to recognize and let it be clear that in our analysis, we talk this language of life wealth and material wealth, right? And life wealth is like using your human energy in the process of making yourself a better human being and making your community a better community. And then material wealth is the material components of that. And so this technical analysis of financial markets, we're focusing on the material component of it. So then we will review the idea of, can a trader get an edge over an investor? And one of my earlier podcasts, we talked about the efficient market hypothesis in relationship to technical analysis and fundamental analysis. As we continue during the podcast, excuse me, we will take a look at the stock market using some of the tools that we've already discussed. We'll look at the indexes first, the S&P index, probably the Dow Jones Industrial Index, the Russell Index, and the NASDAQ Index. And then we'll probably look at some individual stocks. I think these stocks have been doing pretty well. We'll look at Apple, Google, and Microsoft. And then we'll close up our session looking at the Investor Business Daily and the Daily Picture. Okay? All right, so I'm going to start presenting with my my PowerPoint presentation. So if we could go ahead and show that. We good? All right, so just a review, right? This whole idea of Paradigm Shift podcast is just recognizing that today in the 21st century, the rules of a modern, advanced capitalist political economy are different than the rules of the capitalist economy of the industrial age, the 20th century, the 19th century. The industrial age really starting with the Industrial Revolution in Europe, in Great Britain in particular, right? But we are facing what I would perceive is a change in epoch, right? The world is changing. It's almost like it's shifting on its axis. And it became most evidenced during the pandemic. Okay, so we're using a language and a theoretical framework that we feel can speak to this shift, this epoch level shift in socioeconomic environment, socioeconomic conditions. And again, Paradigm Shift Podcast, welcome. Today is part of our menu is like last week we did Physical Friday. Had a wonderful class. Shout out to Scott Sensei who showed up, and we did a couple of drills around karate, and the idea of the exercise, the stretching, the meditation that was associated with that was part of life wealth. Today we're looking at the material wealth component, technical analysis. Again, my name is Curtis Haynes Jr. My education is to the PhD level in economics, and hence my title is Dr. Curtis Haynes Jr. So the podcast is, in general, the whole podcast series is looking at economic and financial literacy. This particular podcast is looking at the relationship between trading and investing. So let's as I mentioned before, right? The impetus of studying financial markets really came in terms of my life. And I just hit on this. Check out the sweatshirt. If you're interested in the merchandise, again, go to our website. All right. Shout out to Rafael Suarez for providing us with this merch. Okay, but from the perspective of black political economy, black Americans, they have a very unique history. If you look at especially the black Americans who are descendants of slaves, right, and that history extends back through the living in communal environments, communal political economic environments, hunter-gatherer economic situation, the way they secure their daily bread, pretty much stolen from that home. Brought through the Middle Passage, and raised in this new environment of a slave political economy, and then through their efforts and through the efforts of their allies, right, they freed themselves from a slave political economy, even though it was like 300-400 years in the slave political economy. And just want to say that a lot of the conversation about race today, right, as an economist, as a political economist, we really do need to like when we talk about race or racism or Black Lives Matter or All Lives Matter, is that we really need to recognize the intergenerational wealth consequences of slavery and the intergenerational poverty consequences of slavery. But what we're doing today is that whole discussion on black political economy. We'll be doing that 2 weeks from now. Next week we'll be doing cryptocurrency, Crypto Monday, and then the following week after that we'll be doing black political economy. But needless to say, well, all 350 million people in the United States, we live in a capitalist political economy. And in a capitalist political economy, generally the way that income is generated is from the perspective of an employee, right here, from the perspective of self-employed, business owners, or investors. And the vast majority of black Americans are wage laborers, and we generate income from the perspective of employees. And in the industrial age, that was radical, revolutionary, because we had transitioned from a time period where the majority of those who were descendants of slaves were generating income generating their subsistence, right, through the process of sharecropping. And then for 300-400 years before that, it was slavery. But today, we live in a capitalist economy, a capitalist political economy, and the economic system is one of pretty much that we generate our ability to earn income as employees. Okay, the paradigm shift is recognizing that there are other ways to generate income. And through this podcast, we want to share knowledge with regard to those other ways, right? So typically, we as working class people, we tend to have the financial habits of the poor and the financial habits of the middle income class. And what that means is that, a lot of us, we work on having just one single stream of income, which is our salary. And if we spend all of our salary, or even more, I mean, the credit debt is significant in the West, significant in the United States. Even if we spend all of that, right, or more, that's the financial habits of the poor. And so we've talked about that in past podcasts. We also talked about the financial habits of the middle income class, where you have money, right, you generate a salary, but with an extra money or the discretionary money, we just buy liabilities. We're not, in neither case, whether we have the financial habits of the poor, we're not paying attention to the asset column. Financial habits of the middle income class, we're not paying attention to the asset column. But the financial habits of the rich, right, is that assets, real estate, stocks, bonds, notes, intellectual property, etc., right, generates income, right? And the income, the idea is this income goes back into assets, and this circular flow, right, from assets to income, income to assets, assets to income, income to assets. That's pretty much how the way the rich play their game. Now, again, this is all hedged in the context of imperialism, hedged in the context of class, the working class and capitalist class, but part of the solution, right, for the socioeconomic condition of black Americans, or at least some, right, is to really understand this process of, in this capitalist political economy, of the financial habits of the poor, financial habits of the middle income class, and the financial habits of the rich. And I studied it, right, and what I realized is that, one, the paradigm shift in my mind, right, my beliefs, the way I see the world. I had to make a quantum leap in how I see the world, from this economics of scarcity to economics of abundance. But in that process, right, understanding the asset column is significant, right? And so let's just say here that the conversation about crypto, the conversation of technical analysis of financial markets is all built around recognizing that you and I have a responsibility to understand financial statements, income, expenses, assets, and liabilities. And then once we understand those financial statements, we have a responsibility to learn, right, how to build up the asset column. You build up the asset column, right, is one way is to physical assets that have intrinsic value, that's real estate, businesses, firms. And, what we feel like right now, what we received in the capitalist political economy are businesses that are, range from sole proprietorships, partnerships, LLCs, LLPs, right? S corporations, C corporations. But from our perspective, right, that, what our goal is here at the Academy is that we really recognize that wealth can, again, take the form of the human being, and wealth could take the form of material assets. And one way to balance both wealth as a human being and wealth in terms of material assets is the cooperative model. So the model that we are using here in Buffalo, New York, through the Academy is cooperative ownership of assets, right? As a learning tool, like, again, like the people who participate in our cooperative model, not everybody has all of their assets that are held cooperatively, but some of our assets are held cooperatively, and we own those assets, and we manage those assets, and we develop those assets as a group, right? So I just want to share that, right? But again, wealth could take the form of life wealth and could take the form of material wealth, and we, in this new paradigm shift, we need to learn both life wealth and material wealth. When we're looking at technical analysis, right, we're focusing on financial instruments that could be traded in the market, and they could be traded in the stock market. So a lot of the conversations that we're going to be having is looking at the stock market and the financial instruments that could be bought and sold in the stock market. What is a stock, right? A stock is a security that represents ownership in a corporation, and they can be bought and sold in a market. And that's why what we'll be looking at further, the role of looking at charts and figures to pay attention to price and volume with regard to the buying and selling of common stock in the stock market. So recognizing that, again, this is a conversation that we did have in the past, but recognizing that we want to build up our asset column. One of the debates in the world of finance is, can a trader, can people who buy and sell stocks have an edge over the investor? Like Warren Buffett, initially he would say that, the disadvantage of a trader is that a trader needs to know their entry price and their exit price. Whereas an investor, they just need to know the entry price, right? And then from the Warren Buffett model, right, you buy and hold. You buy and hold for the rest of your life, and that's how he built up Berkshire Hathaway. That's how he holds on to some of his stocks. He's been holding on to them since he was a very young man, right? So that's investing. But today, a lot of people are trading and making significant income as traders. Now, we also talked about the idea of the efficient market hypothesis that says that really any method to attempt to forecast into the future, right, whether it's future prices or future stock movement or price movements, right, that the efficient market hypothesis, which is taught in a lot of academic institutions, says that you really can't do that, right, that whether you use technical analysis, whether you're using that prices or you're using volume to make a decision with regard to understanding probabilities into the future, or whether you're using the fundamental analysis, looking at the books and the balance sheets of companies and the macro environment to forecast into the future. The efficient market hypothesis says that, like some people say that, history repeats itself. Other people say history rhymes. But from the efficient market hypothesis and a lot of the academic institutions, they don't, right? History does not repeat itself, right? History does not rhyme. And that the key aspect of what you are going to pay attention to is your risk, right? And your risk tolerance. And that will determine how you're going to invest into the future, right? What is your risk tolerance? But the technical analysis, and let me just say both technical analysis and financial analysis, and this is a summary of the stuff we've been covering this last part of season 1, is that both fundamental analysis and technical analysis, the two of them have a perception that we can actually look into the future, right? That we can look at the books and look at the balance sheets of companies, look at macro environment, look at fiscal and monetary policy, and that fiscal monetary policy, the earnings reports, et cetera, all can influence the future. And I myself, right, I have, I believe that in my experience it tells me that we can look, at least gain some level of probabilities. Again, I'm more of the idea that the future does not repeat itself, but that the future does rhyme. And also, that being said, also recognizing that we are facing a change in epoch, right? And we need a language that speaks to that change. Artificial intelligence, that's a hot topic today. Blockchain technology, that's a hot topic today. Now, is it a hot topic or is it revolutionary changes in industry? I believe these are revolutionary changes in industry, and because they are revolutionary changes in industry, yes, there is no precedence. But there are assets that can be bought and sold in markets, and there is a history of that. Right. A matter of fact, what I would say is that, by watching, for example, a particular asset, cryptocurrencies, Bitcoin in particular, once, after 2020, in 2021, 2022, a lot of the Wall Street hedge funds and the Wall Street boys, they started getting into the cryptos, right? And all of a sudden, you start seeing that the movements of the crypto and Bitcoin in particular started mirroring the movements of what was going on in securities in the stock market. And so in that context, even though blockchain, artificial intelligence, robotics are all cutting edge industries, once they are securitized or financialized in the markets, then again, we find ourselves in a situation where history does, to a certain extent, repeat itself, or history does rhyme. All right, so that's a summary of what we've done in the past. So let's take a look at, let's see here. Let me, that's my schedule here. Okay, let's, again, all of you in the Facebook and YouTube Live and TikTok Live, just a shout out. If you have any questions, you could type the questions into the chat, right? And also, we're going to be doing, again, this is the end of a first season in Paradigm Shift Podcast, and we'll be doing this again in the fall for season number 2. So just pay attention and, subscribe to our YouTube channel, right? CIGLA or Sigla Buffalo.com, I believe, is that .com, right? Subscribe to our YouTube channel to stay updated with regard to what we are doing. All right, so what we have here is the S&P. This is an index, and I'm not really going to go too much further into what an index is. We're just going to play around a little bit, right? I'm just going to let you take a look at the kind of things that I pay attention to when I look at the market, but I do look at indexes, right? And this is the S&P 500, and this index is an index that pretty much the industry gauges their skill level against, right? So financial planners, right? Financial advisors, right? Hedge fund operators, if they beat the S&P 500, they get bonuses, right? And if they don't beat the S&P 500, maybe they don't get their bonus, okay? So let's take a look at the S&P 500. Now, what we're looking at right here, right, is this is today. The closing price for the index itself was 4,119. The change, today's change was 0.46 to the downside. And what I have on the chart right here is a 10-day, 30-minute chart. Let me change it to a 60-minute chart, okay? All right, so this is a chart that, and actually I'm going to get rid of the moving averages too. All right, so what we're looking at is over the last 10 days. So if you look at my cursor, this 10, all right, that's 10 days. And if you follow my cursor, 60 minutes. And so over the last 10 days, like these red candlesticks, and that's what these are called. These are called candlesticks, the red and green candlesticks. And so I'm not really going to go into a lecture or training with regard to candlesticks. We'll cover this again in the season 2. So I'm going to assume that you do remember some of the conversation that I did have about candlesticks, but the candlesticks, if it's a red candlestick, that's kind of a bearish candlestick. If it's a green candlestick, it's kind of, it's a bullish candlestick. And again, I'm not going to talk about bears and bulls. I'm going to assume that you've already had some conversation about that. So in terms of day, over the last 10 days, this is what the chart looks like. But let me just show you what the chart looks like over the last 20 years. Let's take a look at that real quick. All right, so over the last 20 years, the movement of, and actually what I'm going to do is this is the index, but there is a ETF. Right, it's called SPY. It's called the Spiders, right? And this is Spiders ETF, and this is actually a monetary following of what of the S&P 500. So if you look at my cursor, right, over the last 20 years. So 20 years ago, right, Spiders were about $97, and over the last 20 years they peaked at, follow my cursor, they peaked all the way over here at at almost $460, but since 2022, and this is the current bear market, right, it's pulled back. Also, this is a monthly chart, so we switched from a daily chart. We switched from an hourly chart, hourly chart to a daily chart, but this is a monthly chart. And so what you see is that there is a trend, right? And the big question is, like, if let's say you are here and this is in 2009, like, would you be able to forecast a upward trend after 2009 into 2010, with some hiccups in 2011, and then the pandemic crash over here, this little pullback right here? Can you predict those? And again, my experience suggests is that you cannot predict them, but you can get the preponderance of evidence on your side. All right, so this is the S&P index. Over a 20-year time period. Let's take a look at it over a 3-year time period on the weekly chart. So in the last 3 years, right, this is part of the bull market, right? And then you see us pulling back, right? And notice, right, is that it peaked here. We have lower lows, right? Lower lows. But since October of last year, notice what we have is higher highs, okay? And what I want to do is, again, this is looking at a weekly chart. Now, I myself, right, a key indicator that I use in my analysis, right, is the simple moving average, right? And if you notice, right, that over these last 3 years, if those of you who remember the conversation, that these moving averages can represent support or they could represent resistance, right? And so if you notice here, the 20-period moving average has operated as support for up until November, December of 2021. Then right here, it broke the 20-period moving average support, but then it found support on the, oh, hold on, wait a second. That's not actually, let me, I thought that was the 20 and the 200. Let me do this again, sorry. But it's still, what I did show was a viable conversation. But these are the moving averages that I typically use. So let me just update the chart. There you go. This is really what I want you to see. Okay, so this is the simple moving average. So again, same conversation, but now it's the 20. Last time I was looking at the 10, but this is the 20. So if you notice, the 20 is operating as support until the bear market started taking place in the end of 2021, right? It broke the support. Now it operated as resistance. And look at here, right? Let's see, this looks like around October of 2022, the 200-period moving average, which is a 200-week moving average, has been operating as support. All right, so if we found a lot of support, we find support, it looks like a little bit of volume, but this is important for us to take in consideration from the perspective of somebody who's studying technical analysis. Because during October up until today, right, the language in CNBC News, you on the financial news, what have you, right, the language you're hearing is about the recession. The language you're hearing about is the significance of unemployment, inflation, and it's relatively a backward-looking language. We're looking back towards 2022, 2021, but if you look at what's taking place in the market, right, this is significant support right here. You find support on the 200-period moving average on the weekly, and now what we have is higher lows. So here you see that the uptrend is established. It was established, let's see, in the beginning of 2023. It kind of challenged it broke this support right here of the 20, but not too much, but it still maintained the support of the 200-period moving average. And, it's kind of like, it seems like there's some support here. Now, what I tend to do is like, okay, so that's the spiders, right? Let me take a look. I'm going to take a look at, let's take a look at triple Qs, right? Triple Qs are the ETF that's connected. Okay, actually, let me do the NASDAQ. Shift dollar. NASDAQ 100, or NASDAQ composite. Okay. NASDAQ composite, now here the NASDAQ dropped Underneath its 200 period moving average again, this is your bear market. It broke the 200 period moving average, right? So that was, the NASDAQ, right, tends to be the cutting edge of the economy, or of technology, or small, the direction that the economy is moving. But notice, right, it did break back to the upside, found support on the 20, and right now it's finding support on the 200. So, so now looking at two indexes, the S&P index and looking at the NASDAQ index, we're seeing support, right? Again, you have a higher lows, so you're seeing support there. That was spiders, right? Now, okay, and let's take a look at the diamonds, the Dow Jones Industrial Average. Same thing with the Dow Jones Industrial Average, right? You're seeing the bear market, right? It came all the way down to the 200-week moving average. It found support in October of last year, and it had a bullish run, pulled back, and then there was this pullback that kind of made people worried, right? But it's, again, you have higher lows from here to there. So, the idea, at least from my perspective, is that I'm really paying attention, and it seems to me that we are might be at the early stages of a next bull market. And then if you look at the language of the idea of the Fed going to ease back on this raising of interest rates, right? A lot of this is backward looking. Again, but let me say, this is not financial advice. It's just that I'm looking at these charts, and this is kind of what I'm seeing. Okay. Now, let's take a look at some stocks, right? What's been on like, for example, Apple. Okay. This is, and actually, I might want to take a look at the daily on this one. Let's see here. Yeah, let's go to like 6 months daily. Okay, yeah. So now I've switched to the daily moving average, right? And those of you who had paid attention, Apple outperformed, and over here their stock price gapped up, right? This is called a gap up. It came down here, it gapped up, and it's right around 170 today. But notice, right? Over the last year, right, again, it went below the 200. Now, this is the 200-day moving average. It went below the 200-day moving average, right, and the 200-day moving average operated as resistance. But now it looks like it's operating as support. If you look right here, it looks like support. And notice also that the 200-day period moving average is gone from a downward sloping curve to a slightly upward sloping curve, right? Now, if I just let me take a look add some Bollinger Bands real quick. Now, when we add the Bollinger Bands, right, it does show, right, that like every time stock price pops outside that Bollinger Band, and again, we could talk about it next season with regard to what a Bollinger Band is, but historically, when a price pops out of that Bollinger Band, it reverts back to the mean. And so here we are, we've popped out of the Bollinger Band. So the short term, I mean, you might see a pullback, but over the long term, over the last, definitely over since March, right? You see an uptrend. If you look at the S&P since March, right? If you look at the S&P since March, yeah, an uptrend, right? So that's something to take in consideration. So going back to Apple, again, also after hours, it's up by 7 cents. So with let's take a look at the weekly. 22. Get rid of the Bollinger Band, right? Extend the time period, right? So again, we're still on the weekly period moving average. We're still above that. And I'm looking at some resistance at about 175, but if you look over a 5-year time period, right, look at this. We're about to get into new highs, right? And the thing is, if we're going to get past 175 or get past to a new high, so the old high looks like about 180, in the 180s, right, 182, something like that, right? To get into this area of new highs, right, we got to get through 182. So, it looks to me that we got a pretty nice run here. I'm looking at another slightly pullback, but, if the market cooperates, Apple is probably on its way to a new high, right? And then Microsoft, I was looking at that also, a lot of good information taking place with Microsoft. And look at this one, right? Again, this is a 5-year weekly chart. Again, the Microsoft peaked out in the fall of 2021, pulled back. But again, notice, now this slope is significant. That upward sloping 200-week moving average, that shows a lot of weight. Let me take a look at the Apple in relationship to that. Now, everybody take a look at this real quick as I switch back and forth. Microsoft prices of their stock has pulled back to the 200-week moving average, found support twice, and now it looks like it bounced off, and it looks like it's headed in the upward direction. All the media information that I've been hearing about with Microsoft and AI and earnings reports is giving the impression that that Microsoft is on its way to a new high, where the old high was around, let's see what it looks like, about 350, 360, and it's currently 307. So as this base fills out, I'm guessing that within the next year, we'll probably be seeing new highs with Microsoft also. But what I want to take a look before we finish this podcast, I want to compare this to Apple real quick, and also looking at the slope of that. Okay, all right. So the slope of Apple's 200 period moving average is also has a nice upward slope to it. But the beauty of the Microsoft one, right, is how significant the 200 period was with regards to acting as support. So I would pay attention to both Apple, and again, if you're playing options or you're playing stocks, managed securities, pay attention to Apple as potential within the next year, reaching a new high. And one last one, let's take a look at Google, right? They're also a major player, GOOG. Now, these are the ticker symbols, okay? Now, look at here. Now, Google is still sitting around this 200. Now, based on technical analysis, when the 20 period moving average and the 200 period moving average are very close to each other, which is what we're looking at, and I'm not sure what the earnings reports came out with regard to Google. Let's take a look on a monthly period to see, not even noticing, right? Let's say 6 months. Right. So over the 6 months, right? Now I'm looking at the 200-day moving period, simple moving period average. It broke it, found support. So now it's on the north side of the 200 period moving average, right? So and then let's compare that again with Apple, right? Apple, their 200-day moving average is upward sloping. That's a little bit better than Google's, right? And then Microsoft's 200-day is upward sloping, but its 20-day moving average is really meaning that it's hitting the charts right now. Okay, all right. So, in summary, this is get back to. Can we get a screen back to me? Okay. You good? All right, so in summary, all right, thank you for bearing with us as we have leveled up. And I would have to say, I'm going to give a shout out to my production team, Khalil Mohammed, Jasmine Ramos, Rafael Suarez, right? This crew really allowed us to, and me, myself, to level up. The production quality that we've done in the spring, our first season, is significantly better than any of the attempts that we've done in the past. And I know some of you have watched some of our podcasts in the past, but we're leveling up. So if you're interested in the material that we're covering, economic literacy, financial literacy, life wealth, karate, if you want to practice some karate with me, just subscribe to Sigla, CIGLA.com, YouTube, to our YouTube channel, and you'll get an update. Or if you could go to CIGBuffalo.com and subscribe there. And if you just want to follow me, it'll be Dr. C. Haynes Jr. at all social media. I'm on Instagram, I'm on TikTok, I'm on Twitter, and Facebook. All right, so we have 2 more podcasts for our first season. The next podcast will be Crypto Monday. That will be next Monday. And the last podcast of the season will be Black Political Economy, the Tuesday after that. So, again, thank you for sharing your time with me and with us. If you haven't subscribed yet, go ahead and hit that subscribe button and watch us grow. Be part of our growth.